we've seen a lot of companies fail in the later stages. It's because of this.
The success rate of startups which are operating from IIML EIC is more than 91% as on date.
Nobody is going to fund for those losses for long. Business has to earn on its own.
When you allow reality to compound faster than your own learning,
customer voice or the market need is much more or a higher priority as compared to what you feel. Why startups fail? I think we are a part of this Startup Hub subsection, and I'm sure a lot of you are either wannabe startups or are into some of your entrepreneurial journey already. And I must tell you, the kind of panel that we have gathered together today, it's the best that you could have to talk about this topic like why startups fail, because we have a mix of different kind of startups who are growing, some very fast, some at a slow pace. We have a couple of venture capitalists who are here who have seen plethora of startups during their journey, to see how have they taken their journey or shape, and what works, what does not work. So without waiting for long and coming to right to the question, I would like to start with maybe Ashish. So Ashish, you have a considerable experience in investing into some very early stage startups, and one of the most important aspect when you are investing is whether it is going to be successful or not. Because if it is successful, then it's 10x, 100x, whatever x amount of money that is waiting for you. And if it does not, for example, then it's a big setback, right? So what all aspects do you see when you pick up a startup, and what aspects do you see why startups typically fail? So maybe the most important aspect that you like to look at is what we would ask for.
thanks very much. Pleasure being here. I think that's the longest question, trying to ask in terms of what do we look for, why do startups fail, but I'll give a very simple perspective in terms of what it is. You talk to any investor on what it takes to kind of back a company, and the response usually is the founder, right? And the core for us is therefore to kind of make sure we're backing the right jockey, right? And someone who can navigate through tough times, someone who can lead a team, someone who can build a market, open a market, multiple trades coming in, a true superhero or a superwoman, however you want to look at it, right? But so I'm going to ignore that aspect. That's a consistent answer you will hear from everyone in terms of what do you look for a founder, what's in there. When we are evaluating a particular company, I think the large part, once we've assessed that yes, this is the founder, they have the chops to kind of go out and build something, where we spend large time of part of our time is around, is the market right for this opportunity? And that's where more often most people fail as well. When I say they fail, it's about you are reading the market wrong, right? You believe there is an opportunity, you believe that this particular segment will go out and buy my particular service, you assume that this particular segment of customer or client requires this kind of a capability or an outcome or a feature, and that's the way to solve for it. And these are the various aspects in terms of where you fall apart, right? I'll give a small example. Decades ago, I used to work with a company called Anderson Consulting, which is now called Accenture, right? Back in 1999, our global CEO, he left the global shop, he was a CEO, and he said, I want to start my first .com company, a company called Webvan. A global guy, Accenture, quitting, he raised $800 million back in 1999 to set up his company called Webvan. What was Webvan all about? It was an online grocery store, okay? But for 1999, you were just way too early for that particular market, right? You can imagine that. A lot of you probably were not even born in 1999, but that was the reality, right? In India, if you could look back in 1999, there were hardly any digital transactions. We didn't have UPI. We would just kind of prefer and go grocery and buy from the nearby neighborhood retailer. We still do that. But 15 years later or 18 years later, Instamart came with the same idea, with probably less amount of money, and they were hugely successful, right? And what the founder, and from a pedigree perspective, George Shaheen, who was a global founder, he had the right jobs. Everything in the credentials worked for them, but you read the situation wrong, you read the market wrong. No matter what you put forward, the market wasn't ready. And that's for me the fundamental reason as to why startups fail. There are many nuances we can build on that. Yeah.
That's really insightful, because this is one of the most important aspect. If your product or service is not ready for the market, then it is bound to fail. It is not going to make money, and money is like the mantra for a startup to be successful. So wonderfully put, Ashish. And I'll now move on to Karan. I think Karan, you are in a similar space. Do we have a mic for Karan? Karan, you are in a similar space. Ashish has a point of view wherein he mentioned that market readiness or product or service being fit into the market is something that they see as the most important aspect. Do you concur, or you have anything to add, or you differ with that?
Thank you, Ashutosh, and thank you for having me here. I agree with every point that Ashish has said, obviously, and there are many deeper aspects. So I'm going to touch upon a couple more points here. One is product differentiation. Now, I think it's important that when you're building a product, you need to differentiate yourself in the market. You can't be a similar product, trying to capture most of the market. In that scenario, about 2 or 3 products may survive and the rest will fail. We've seen this dime a dozen in the consumer industry, where there are so many beauty products, pretty much similar. They all use the same contract manufacturers, and then over time you realize that 1 or 2 will survive, whoever has been capitalized heavier. In order to understand this better, and we're investing in the electric mobility space, so what we've seen is the two-wheelers, there's literally a two-wheeler manufacturer in every block, every other block, with really no product differentiation. They're just ripping off the chassis from the internet, very similar, and outsourcing your batteries and powertrain to build it out. Now, in this case, you're competing against legacy players who have large distribution channels. Makes it very difficult for them to create kind of or let's say capture the market. But in case you have built IP or some unique technologies within your product, something that customers are willing to pay for, you can't build something that's super expensive, does not meet the market, makes it viable, then yes, those products will survive, they'll do better. I'd like to add one more point to this, is unit economics. When founders actually set up companies, they ignore unit economics. They feel that capital will help them survive till eternity maybe, and at some point they realize, and we've seen a lot of companies fail in the later stages. It's because of this, because heavily capitalized companies are not able to grow their business, or they don't have enough capital. India per se, if you look at the domestic market, we do have capital available till Series A, Series B. Most of the larger capital comes from international investors, and those $100 million checks. But if you're still capitalizing your unit economics to, or let's say the discounts that you're offering, I think you're setting up for failure.
Thanks a lot, Karan. I think I completely agree with you, and feel that unless and until we have that business model which clicks in place, it does not work well for a startup. Because even if there is a demand, there is a need, but if the business model does not exist, if you are going to burn, you are going to bleed, then it is not going to work at all. Completely agree with you. And we have with us today Yamini. So Yamini, I think I talked with you, and you have more than 300 startups, in IIM Lucknow incubator, and what you work upon is the after product stage, which is sort of a marketing stage. And I think that's where both these speakers spoke about, as to how do we take care of that aspect. Maybe what Ashish spoke about, it has to be taken care of well in advance, because you have to create a product which fits the market. But what Karan talked about, I think a lot more has to be taken care of after the product has been created. So how do you cover those aspects? One aspect wherein product market fit has not been seen at the inception stage, that's one scenario. And the other one wherein product market fit is good, but how do you build that business case? So how do you tackle some of these scenarios?
Yeah, thank you for having me today. So I represent IIM Lucknow EIC, which is the entrepreneurship and innovation arm of IIM Lucknow, and we have a corporate office in Sector 62 Noida, and then we have physical centers in Lucknow, Agra, Gorakhpur, and Indore. So as Ashutosh rightly pointed out, we have more than 300 startups operating from our business incubator, and then similar number in terms of MSME support as well. But what's interesting for us is that somehow we have been able to create a model where the success rate of these startups, because we are talking about how startups fail, the success rate of startups which are operating from IIML EIC is more than 91% as on date, which is absolutely reverse of what the ecosystem shows, which is 90% of failure rate. And that's, we have been able to build that model over years by refinement and then building a framework how to choose the right set of startups. Now talking about, and then of course, since we are back from IIM Lucknow, the area of expertise for us is looking for startups who are ready with their product, want to commercialize, want to scale their technologies and innovations. So we are there to acting as an expert to help them, handhold them. But when we talk about why startups fail, apart from a common factor which is the founder conflict or composition, which most of the VC firms, and we also in a way act as investors because we have our own corpus, we are working with various corporates managing their funds, which is more than 2,000 crores and so we look at from different aspects. And if we break from, apart from just a founder composition or founder conflict, there are reasons at 3 different stages. So let me break it into pre-commercialization stage, commercialization stage and scale-up stage. So at pre-commercialization, the major reason which we see in terms of why startups are failing is possibly lacking how to explore the product market fit. Now this is a very generic term, but are we doing some kind of MVPs with real users, the users who are ready to pay for it? And if we are able to do that, and if we are able to reiterate that time and again, taking feedback from these real-time users, taking feedback and then improvising our product and innovation or technologies and then again relaunching, exploring the right set of framework through which we can explore the right product market fit for the company is where these startups majorly fail at a pre-commercialization stage. But let's say if there are startups which are ready with the product, they have entered in the market, they are successfully commercializing and doing some good revenue numbers. There, as panel rightly said, unit economics. So the cash flow management is very important. But I've seen majority of startup founders lack this understanding of the concept even for unit economics. So cash flow management is very important. Sometimes they want to attain speed and then they raise heavy amount of funding and then they burn very quickly, which is another major bottleneck in terms of why they are failing, because of lack of understanding how the unit economics for the company should work. And third is, we have seen the startups which are at a advanced stage, who are trying to scale. There possibly the expertise of these team members or the co-founder comes into picture. Because even if you are able to, you have been able to create the product market fit framework, or you have been successfully taken the account of for unit economics part or cash flow management, not many startup founders are having that expertise of how to create an organization out of a startup. So that's another area where a startup founder has to be very careful before entering into a scale-up mode. And I think we have a very vibrant panel sitting here from IIT, IIM, international delegates, and then VC firms. So I think this is a good panel where the startup founders can avail a lot of benefit and expertise. Thank you.
Thanks, Yamini. I think very heartening to know that 90% plus is a success rate in IIM Lucknow, which is almost opposite of what we typically learn and see, that 90% is what typically fail. But they fail over a period of time. It's like maybe a couple of years you will see 50%, and then another 3 or 4 years, then you'll see another 25%, something like that. So I think the key is sustaining in the market. I think so that's very important. And you rightly mentioned about the 3 stages. One is the pre-commercialization, wherein you identify the market fit, product fit. Then the commercialization stage, wherein you see the moolah coming in, the unit economics and all that stuff. And then the scale-ups phase, which talks about the sustainability. And a startup, to be successful through the years, has to navigate all these stages successfully. So it is very important. But we are fortunate to have 2 people in our panel who are representing very, very different journeys of a successful startup. For example, I'll start with Sachin. So Sachin represents ProcMart. They have been in the business for almost 10 years now. So 10 years is not something which is an easy amount of time to handle. All those who are doing their startup would agree with me that 10 years is a very long time for a startup to sustain in the market. So we would like to listen from Sachin as to what made them sustain in the market for such a long time, what is making them clicking right now, and what is that their next level of thought process is, which will take this startup to the next level. So Sachin, over to you.
Thanks Ashutosh for this question. And when I was invited for this panel, the topic was why startup fail. The first reaction was it sounds very negative topic, that why startups fail. We should talk something positive. But I think it is important to learn from others' failure so that we don't repeat the mistakes. And there are ample examples where we have seen that there has been startups who have founded the organization, developed the product market fit has been there, they have been able to get the customers. But somehow still something or the other happens that a startup fails. So if we ponder over why the startup fails, as our colleagues have already talked about that there are various stages of a startup where we are looking at a product market fit, then maybe we have got the product market fit, we are trying to scale up, and then the third stage where we're building the organization to a larger scale. So I'll talk about from my experience at ProcMart. We are a B2B indirect procurement platform, and we help large manufacturing corporates in their indirect procurement. So whenever we are farming any startups, what is important is to be seen is what is the problem statement we are trying to solve, and we have to stick to that. Generally, I have seen that in a bid to scale up, we sometimes forget what is the problem statement we are trying to solve when we try to get into some different zones, some different ancillary products because we want to scale fast. So I think it's important that whatever core product we have thought of solving the problem, we stick around that. And that's the biggest learning we have got at our organization, that we are not drifting away to scale fast. We are sticking to the core, that what we are meant to solve will solve that. And though it may take a little more time, but it will help us to scale and build a robust organization, which is a sustainable organization. And if we have to split this into a B2B or a B2C, in B2B, by no way a startup can survive if there are no unit economics. Nobody is going to fund for those losses for long. Business has to earn on its own. In B2C, still we can have that situation that maybe today we are giving some products to customers who get hooked to that product. Tomorrow we may go some for price hike and something and we can recover. But B2B, from day one, it has to make unit economics. The moment we try getting into businesses which are loss making or impacting negatively the business, we are waiting for our doomsday. So that is one part. I would say that unit economics is most important aspect in B2B business. We have to sometimes control our emotions, our eagerness to scale fast, and that is what we have done exactly at the ProcMart. So we are building our business in such a way that we are able to serve customer well, and we have to also listen to the customer feedback. That is the most important thing. I would tell we have learned a lot from customers. Our customers have taught us, which are players in the market since long. We are serving to Fortune 500 clients. They have actually taught us many times how we have to serve them, and we should be open to learn from them. Rather than getting into a zone, we know how to run our business. We should be open that we have seen many examples actually that customers have said us that we are looking for this solution. You are providing us this. Can you modify your solution proposition to this? So the moment we start engaging with the client, listening to their problem statement and trying to solve, it builds a good relationship, and we are able to scale fast. So I think I can talk enough on this topic, giving examples from the organization. But we have, I think, the time limitation. One or two more things I would like to talk about, again, since I also come from a finance background, that working capital management is the key. We may think that we have raised money, we have enough money, but we have to have a long-term vision that, okay, this money is sustainable for how long? We have to think beyond. It's not that today we think we have got the money, we start spending money, and then we realize after 6 months, oh, we have just exhausted our money. So we have to be ready that when do we want to raise next fund, what are our milestones for next funding round, and on what basis we will be evaluated by the VCs or the private equities for the next stage, and try achieving those milestones before we start burning hard-earned money too fast. So that's it. I can add too much, but
No, thanks. Thank you so much, Sachin. I think you picked up, very critical points. I think starting with listening to your customer. I think a continuous ear with your customer is something which is very much required to build your product well as per the market requirement. It has to be continuously evolving. So product once made is not something which is like a finished good. It has to follow a continuous evolution cycle, and unless and until you are close to your customer, you would never be able to see what is the next set of features, next set of additions which you need to bring to your product or service. So very critical. Second, being flexible, to see what all we can learn from the failures of others. We should be flexible and we should be adaptable. We should need to learn from them. And working capital, I think we should have a separate panel on working capital and finance management. Yeah. We'll pick it up from you and see how's that the startups navigate from that particular aspect. But let me share with you all. We have Olga with us, and her story is something that every startup would like to listen, and I'll tell you why. Because this is one startup. She represents A7. A7 is a Russian organization, and she'll talk about it more herself. But the most important aspect that I like about A7 is that it's a startup which has already seen huge success in 1.5 years of its establishment. Now this is a story every startup would like to listen and learn from, and I would request Olga to share the secret sauce for the startup's success.
Thank you so much. Thank you so much for having me here. It's a big honor and privilege for me. As it was said already, I have 25 years in experience in finance, and more than 20 years I have spent in biggest commercial structure. Like I have started from commercial banking, then I joined Central Bank of Russian Federation. I was top manager there. Then I joined Binance, the biggest crypto exchange. And 3 years ago, I decided to open my own consultancy company. And actually, I'm consulting a lot of projects in Russia, mostly in Russia, sometimes of them in CIS. But I really see not from outside how startups are built, how they scale, how they fail, unfortunately. And and one of my clients, this is a A7 project, which, as you rightly mentioned, the company was launched only in the late of 2024, but now it is really the biggest, one of the largest ecosystem, not only in Russia, but also globally. And it is a lot of information in mass media, in Wall Street Journal, in Financial Times, and this case is I really find very interesting as a phenomenon. Why? Because during such short period, the company was able to achieve big results. And when I analyze why startups fail, I really see that the key reason actually lack of real product. There is no customer demand, but I don't know why, but people believe that they should start to scale, to increase costs without proper team, without understanding the real business. And actually, why the A7 project is really unique, because they really have the product. They really have the product. And the core of this product is a combination. First of all, this is promissory notes. And this is not just a traditional promissory notes like legal obligation for payment. This is enhanced by advanced technology and unique team, which is helping to build all infrastructure around it. And actually, there is also A7, A5 stablecoin. This is the biggest ruble stablecoin in the among non-dollar-based stablecoin. So, and what this product is designed for? We are talking about cross-border payments. You see now that we have SWIFT, and there is no alternative globally for SWIFT. But Swift is, honestly speaking, sometimes slow, expensive, and sometimes you see the geopolitical situation. For example, Russia is excluded from Swift settlement, yes. And actually, the A7 project, they have real demand for this cross-border payment. And we see that a lot of different counterparties, they are trying to find alternative to SWIFT, but it's difficult. We see a lot of experiments, for example, of BIS, Bank of International Settlement, which is experimenting with CBDC, Central Bank Digital Currency. But still, this is experimental, this is not real business here. We also see crypto as a parallel financial system, but it also doesn't work properly, because finally all regulators are clear that the final settlement should be done in traditional money. So actually what we see is that there is no alternative to SWIFT. And what the A7 introduced, it's real working alternatives, and we see that the business is huge. Now company is expanding globally. Recently the settlement center in Asia was launched. A lot of offices were opened in Africa. So we are talking about hundreds billion in transaction volumes, and this is actually what works. So my point that actually this case is the opposite case to what a lot of startups fail about. Yes, because when you start your business without the real product, without real customer demand, eventually and finally, inevitably, you will fail, unfortunately. So, and I'm really happy to present this case, because for me it's case like really unique, and it is helping Russian exporters and importers to continue business.
Thank you so much. Thank you so much for sharing the insights. And I think this startup kicked all the boxes, that's the reason it is so successful. I think they are taking care of all the points that have been raised by our eminent panelists, wherein product market fit, unit economics, being close to the customer, all those boxes are ticked already. And that's the reason probably it's doing so well. And we wish you all the best, even in coming future. So I'll come back to Ashish. He talked about, product market fit, the environment. And, one thing, that I would like to add, I have worked in the telecom industry for almost 15 years. I have very closely seen how the regulatory and policies of government, and they all are considered the market fitment and all that stuff, is so critical for the success of your business. So I've seen so many ups and downs coming in the business as a part of the industry. We need to ensure that whatever product we are building, it complies with the regulations and the policies of the government, that you are undertaking that businesses. And I think, that's one of the very important aspects. But coming back to Ashish, I think your point of product market fit, would you like to share some example or something that we all should follow as the startup entrepreneurs, or should not follow, while building your product or service market fit? So how should we avoid that, point of failure, for example?
I think it's been said before by the fellow panelist. When we back a young company, the initial few days or the initial few hours, or even prior to putting in the money, we spend a lot of time trying to understand if they have ears on the ground, eyes on the market, ears on the ground, and they're spending adequate amount of time talking to the customers. You may not have a product, but you have to take your idea to the customers. You have to scan through the market and figure out where the real opportunity is. And as you keep evolving, we're talking about startups, but large companies also fail. And we'll talk about that in a minute. But for a startup, is it therefore important that the first product which you take to the market, this is a relevance, and you've done your sense check, right? Where often people lack, entrepreneurs lack, is we've realized that they over-engineer. And I'll tell you what I mean. I'll give a very crude example, just to kind of build the energy as well. We backed a founder. The founder said, I want to design a bell. All of us have ridden cycles, and cycle had a tring bell. That's what the founder wanted to build. Okay, we gave him money. Here's $100,000. Go out and build that bell, right? Three months later, we went to the lab and he said, hey, I've got the first iteration of the bell. We said, okay, demonstrate that iteration. And he showed us the bell and he pressed, it did ring. He said, but this is not perfect. You know, this string which is coming out, you know, it just lacks something and I want to work on it. Okay, so work on it, more on it. 3 months later, a few $100,000 also money in the drain, and you know, we back there, and he said, okay, my product's ready. And he pressed the button and it did ring. And I said, it looks the same. He said, no, this string is a little different. But I'm still far away from perfection. And you know, give me another 6 months, I'll do that. Or we put in some more money and he went ahead. 6 months later, we went there, the same bell, it did the ring, right? But you spend the full 2 years sitting in the lab, just iterating and building the product, which in your head, you imagine that's what the market needs. But the market's far apart. And the big reason therefore, and the key point is, when you allow reality to compound faster than your own learning, you know, that's the biggest pitfall, right? And I think that's what we should look for. That's what we need to guide people. Stay relevant, stay in the market, keep evolving, and keep developing something which is true to the need.
Absolutely, yes. Staying open to, you know, what the voices from the outside are saying to you, not your inner voices. You know, so your inner voice is important, but when it comes to your product, the customer voice or the market need is much more or a higher priority as compared to what you feel whether this should be there in your product or service or not. And you know, aptly put, I think apt example I would say, you know, there are bigger examples as well. You know, you talk about Nokia, one of the largest selling mobile phones in the country, but you know, lost to Samsung. You know, we had BlackBerry, which used to rule the market one point in time. They are nowhere today, not even heard. A lot of new generation people don't even know what BlackBerry is, while it used to be my favorite when it was launched. So, you know, thank you for sharing. You know, I'll go to, you know, Karan now. Back to you again, Karan. So you talked about unit economics. I think I would again, you know, pose a similar question to you. You know, if you have any example to share when something worked remarkably well, you know, while designing the unit economics of a product or service, whether it's in your own portfolio or somewhere outside, or something that, you know, drastically failed, for example, wherein we all should learn from. You know, any example that you might like to think, or you know, what should we keep into consideration while driving that unit economics? You know, how should we test market that? You know, something might work on paper but might not work in the market. How to navigate this?
Thank you, Ashutosh. Great question. I'd like to start by saying that in the mobility space, we've made 10 investments and we have 0 write-offs in 5 years. So we do understand this, you know, this space pretty well from a, you know, investment standpoint. But unit economics is something that is very core to our objective of investment. And I'll start by giving you an example of a two-wheeler company that we invested in. Now, India is the largest two-wheeler, you know, market globally. I mean, we sell like 20 million bikes across the country on a yearly basis. And we believe that the gig economy over here is, you know, we have about 7 million or 8 million gig riders going all the way up to 20 million, which, you know, plugs into all your Zomato, Swiggy, Zepto. So it's a really large market. And how do we attack that market? Because two-wheelers is so huge, and, you know, we believe that electric vehicles obviously will capture over time at least 30% of that market. So we wanted to make an investment in the two-wheeler space invariably. I mean, I think everybody would believe that yes, largest market, largest piece, we should have an investment in that space. So how do we, you know, approach that ecosystem? So then we looked at all the entire two-wheeler markets, or let's say we went straight to OEMs, first port of call, and we realized that OEMs do not have any, you know, technology that makes sense, or, you know, the price points actually don't work for the market. And therefore we went into the services business. When we moved to the services business, we realized that what most players are doing, they're running 3PL. So the 3PL is third-party logistics. So they're basically, they have the two-wheeler, they have the driver on their payroll, and they do fulfillment. It's like 3 times the risk. Though the numbers look excellent because you're taking all the revenue in your books, and then you're making payouts. to it's the drivers, for the bikes, for the fulfillment, but you've already also taken on 3 risks. So your gross margin is actually shutting down. I mean, you're literally operating at less than 15% gross margins. And that means that in order to manage this entire setup, you need a large corporate structure. And therefore, you're spending so much money on your G&A and you're not able to turn profitable, and you'll never be able to turn profitable over time. So we broke this down and we figured out which player will actually be able to turn profitable on which piece. So we said, should he manage the asset, which is the vehicle? Should he only manage the drivers, or should he only do fulfillment? And when we broke it down, we realized that only managing the asset makes sense, because over there you will operate at like 40 to 50% margins. And this is where unit economics comes into play. So you have to break down every aspect of the business. I can give another example if we have time, or so a quicker one. Everybody knows that battery swapping is a very large play, again, because for the two-wheeler market. But little do people know that battery swap actually makes sense only at a particular number, which is between $75 to $80. But no two-wheeler player wants to swap at above $40 to $45. How is it possible that this business is going to survive? How much ever you want to capitalize it. And whereas charging for two-wheelers runs in the space of about $20 to $24 per unit of charge. So this is how we look at unit economics on an overall basis. So whether the business model really is able to absorb your, absorb your cash flows, you're able to create a valuable business. And one advice we give to founders is that please build value, not run for valuation. So not the other way around, right?
Thanks a lot, Karan. So, very well put, and very apt examples for us to learn from. Because unless and until you have the bottom line clear in your head, it is not going to work. I always tell the startups that we have that if you have to pick between revenue and profitability, always go for profitability, right? So I think there is something which has to be clear cut in our head before we execute anything. Coming back to Yamini, I think we would love to hear one turnaround story wherein there is something which was not working well for a startup, and with an intervention it could change the we call it pivot, and it started working well for them. Whether it is pivot or whether it is something that fundamentally they were missing out in their journey or in their process, and when it changed, it started working fine for them. So any story that you would like to share with our audience?
Yeah, sure. I won't name the startup, but basis the challenges that they face, I would like to highlight 3 important points, and then we were working on these specific pain points, and these were the 3 reasons why they were struggling a lot, and then somehow they moved out of it. First is that when 2 or more co-founders are working in a company where they divide certain roles and responsibilities, let's say some of them are into core technology or innovation, other aspect or other group of people are into business development, sales, marketing. That's a general division that happens within the team. But then none of them actually factor in a dedicated responsibility of raising funds from the market. And then when this particular responsibility kicks in, what happens is, this is a dedicated job, that's a dedicated requirement for any company to continuously look out for raising funds from the market, right? And this requires a lot of your time, which startup founders doesn't factor into. So something similar happened to one of the deep tech startups working with us from last 9 years. Somehow they didn't figure it out and factored in the time and the engagement that is required while taking care of their cash flows as well to raise funds from the market. And for them it took more than 18 months, which was a terrible situation, though they were sitting at a valuation of more than 100 crores, doing pretty well from the market, AI based company. But then if you're not factoring in a dedicated responsibility of raising funds from the market well on time, because a funding process might consume as low as 3 months and as high as even a year's time for you. That's one of the major pain point which we have seen from the startup founders, because they don't factor in this particular problem. Second is the regulatory framework, which I think Ashutosh also pointed out initially. Since we are building something, we are selling something, we are creating revenue out of it, we are scaling, we don't factor in the regulatory aspect of any company, which is equally critical. And then when you reach out to entities or VC firms or corporates for raising funds or doing any such activity, or maybe expanding outside India, these regulations stop and become a bottleneck for you. So what happens is, you are on a verge of raising fund, the VC firms, even at IIM Lucknow, we get into due diligence process, and this is a rigorous process, right? And this requires a lot of operational due diligence, financial due diligence, technology due diligence, lot of various criteria are there to do a due diligence for a company. And if you are not deemed fit for any such, because of the lack or gap of that particular regulatory framework, then the whole process stops there and then. So it is equally important to take care of the regulatory framework of the company, which is a missing aspect. And third and the last point I would like to highlight here is, and again this is coming from what we have seen in the past with our startups, specifically for deep tech and the startups who are using cloud services and paid cloud services, right? This becomes a very major expense and sits heavily on the balance sheets of the company, which people don't factor in. As you scale, your expenses in terms of consuming those paid cloud services from the big players in the market is equally critical. So do factor in that expense as well. So these are three reasons which is
I think
equally.
you covered a very important point. I think Sachin mentioned about the working capital management, and when you buy this, space in the cloud, it's a large impact on the working capital, which comes in. So it's a great decision to be made, or very critical decision to be made, wherein it has to be in-house or it has to be in the cloud, and some of those decisions really impact the bottom line of the business. So I'll come to Sachin again, and you were talking about working capital, and we would definitely love to learn from you how's some of those nuances or tricks which help you manage your working capital, which you take into consideration whether you go through them on a weekly basis or a monthly basis, or what are those frequencies of making those critical decisions with respect to keeping your working capital optimal, so to say.
I think in managing the working capital, it is the discipline only, nothing big things to be done. From day one, we need to be clear that what is the working capital cycle our organization has to work on. We need to be clear that, okay, this much is the maximum credit period I'm going to allow to the customer. We sometimes need to learn to say no also to a client if the credit period demanded by the client is higher. Because initially it may look tempting to onboard that client, but gradually it leads us into a problem. Similarly, while managing our creditors, what is important is that we have to also look our creditors, our suppliers as partners. And once we do that, then they become our partners, and they also help us in enabling and managing our payables at a higher lead time. So I can give you some examples from our organization that.
I'm sorry, Sachin, but we'll have to just be
okay.
a little crisp.
So I would just say it's discipline in managing the working capital, and also art of saying no sometimes to scaling fast in the better interest of managing working capital, and continuous periodic reviews.
Thank you so much. So we'll come back to Olga again. I think you mentioned that you have been taking care of some other organizations apart from A7 as well. So in your experience, would you like to share some other stories, wherein things have worked well or things have not worked well, where we can learn from?
Yes, for sure I can, but for me the A7 Sharma story is really a phenomenon, yes. So I would rather stick to this story, but I would like to comment, if I may, for regulatory compliance cost.
Absolutely, yes.
Because as I said, I was during 8 years top manager of Central Bank of Russian Federation. I can tell a lot about regulatory compliance cost, but I really believe that actually regulators should be smart. Because if your cost will be too high, you will be nobody to regulate. You will simply kill the business. And this is from regulatory point of view. From the business point of view, I really believe why the A7 project is very good, because they find the proper balance between risk-taking capacity and risk-adverse capacity. Yes, they find this smart balance, because if you will 100% compliant with everything which is required by the central banks, by Ministry of Economy, by Ministry of Finance, by tax authorities, you will simply die. So I really believe so you need to find some flexibility and proper balance which will help you to survive.
Thank you so much, Olga. No, I think we heard a lot from our eminent panelists about all those do's and don'ts that you would need to look at when you're building a startup for yourself. And each of them, I'm telling you, is very, very critical. I think we have to take care of all these aspects to ensure that our startup is on track towards profitability, making money for ourselves and our investors. So that has to be done. But let me share with you, also the other side, of the startup, wherein it's a journey of a founder which has to be, so much patient, so much, full of troubles which need to be navigated day in and day out, wherein all these things, like juggling balls, they have to be managed on a daily basis. It is a very, very, difficult journey, and every founder has its own journey, that they have to, follow. But there's a softer aspect that I would like to add, wherein if you have an entrepreneurial startup, if you are a founder, apart from taking care of some of these advices, please keep somebody as a mentor for yourself. Someone who you can trust, who you can bounce all your ideas with, who can give you genuine advices when they are required. Even if that person is not very intelligent with respect to the market, but he or she can take care of some of those difficult periods in your journey, because a startup journey is full of ups and downs. So have someone trustworthy as a part of your ecosystem, who you can go back to whenever you are facing difficulty, and who can help you navigate through those difficult times.
I'll request the esteemed moderator to please do us the honors of presenting a token of our appreciation and thanks to all the esteemed speakers. We start by thanking Mr. Ashish Taneja. We thank Ms. Olga Goncharova. We thank Mr. Yamini Bhushan Pandey. Our thanks to Mr. Sachin Jain. Our thanks to Mr. Karan Mittal. And to express our thanks and gratitude to the esteemed moderator, may I invite on stage Ms. Sakshi Chavla from Exhibitions India Group. We thank our moderator, Mr. Ashutosh Sharma. Thank you for initiating and being a part of this discussion and making it so interesting.